Hey guys, this is Chris from Husky Trading Solutions. Hope everybody's having a good day. Well, how do we put it? Today was a pretty awesome day in the markets. It is 6/22/2017. I wanted to go through for some of my students and anybody looking to join. I wanted to go over a lesson, yet another lesson in a variation of our 30-minute candlestick bars. What we are doing here is we've kind of okay, one second here. Let me step around here. We've kind of taken our 30-minute bars, and this is a assortment of bars of the markets that we follow, gold, ES, NASDAQ, natural gas, 6E, oil, Dow, etc. So we have a couple other ones that we follow too. But I wanted to show you a little bit of a difference here. We've taken a NASDAQ is going to be the star that I want to talk about today. What we've been looking for is origin points of where these moves are beginning and importantly where they are ending. And what we've done is we've kind of made a variation on these 30-minute candles and started looking at share bars. Okay, what the share bar is, it looks very similar and you're going to get a lot of the same movement, highs and lows, but what these share bars are doing are really showing you who is in the market, where, and where the drives are coming from. So we are looking at origin points. Something that I like to look at are basing areas or congestion zones, and something that I have labeled here, I'm going to put a box in here. This is something that we can see, mapping out some highs, mapping out the low of the move. In this case, what's really going to be important is where did the market break out, or where did we decide to leave this area behind? It was accepted price, now it isn't. So this was accepted price until it wasn't. So what was the catalyst that drove the market out of there? Okay, it could be a number of reasons, but this is going to be a focus. Okay, the market traded up until it didn't, created a nice high wick. Market traded up until it didn't. Okay, so we can see the open of this red bar. This is where sellers stepped in. So these are all things that pre-market we can view, and we can start to kind of get a sense of what's accepted, what isn't, where a general rotation is going to occur. All right, so in this example, the two star bars here are just going to be one, the breakout bar, right here, breaking out of this congestion zone, and two, the high of the move, so this bar right here. All right, and all that's doing is working to build a map and what is going to be tradable in today's session. So as the market opened up, this is going to be a day session, day 1, day 2, day 3, so we can kind of follow that with the calendar down in here. This is all of today's trading session. All right, what did we start out with? We opened up kind of right in the middle. Let me erase this chunk. One second, what I do with my drawing tools. We opened up right in the middle of a range, of a breakout bar. Here's our low extreme, here's our high extreme, and after a few of these bars, and again these are share bars, in this case NASDAQ we're using 10,000. Okay, that seems to be a pretty reasonable number solely based on its average daily volume, and traded down to test our first area. In other words, it is testing this base. Okay. If price does not get accepted back into this base, this is no longer fair value, and this breakout bar will give us a extreme or underlying support. So we can see that in this case the market traded down and it found a bottom in this wick. So this is what we would look for as a entry point, a buy zone. Okay, almost traded right to the tick. We're looking at this wick as risk. So as long as we don't trade, and more importantly, we don't have a bar that closes below it and trades below this point, this is what we're looking at as far as risk. So not really that much. Now, something to keep in mind here, this wick can trade through it, but what we're focusing on is this bar and how it closes. So it did not even come close to closing below or inside of this wick zone. So that's a good sign. That's a sign of strength for our move. So throughout the day, we followed up, based a little bit, followed up, and got us right to our upper extreme. Okay, wick zone. Okay, this is where sellers came in and shut off the up move in order to take this thing lower. So I have an example of this in a trade I'd like to share with you guys. It was one opportunity of many, and this one we did take with the class, so I know that a few of the students were in it. I always like to see it when my fellow students are putting themselves in a situation to make money, or even getting practice on the simulator, because that's what this is all about. You have to practice this stuff over and over again on the simulator to get a good feel and to get an idea of how to mark out these points. All right, so we can see here on a 610 tick chart, red line represents the high of that extreme. Let me erase all this junk again. And set a limit order right at that open of that red bar, expecting some kind of response. So that's something that we should see on a daily basis to some of those bigger extreme bars, some type of response. Okay, so had a limit order, got filled at 58.06 half. Started out with a 5-point stop in NASDAQ. As far as dollar amounts, that's about $200, so not a whole heck of a lot of risk for anybody of you guys trading. That really is not bad, and that gives us a starting point. Once the market starts trading in our favor, we look to reduce risk and even move to break even. And this was a nice trade. Once we tested that top, could not make it any higher. That's a double top formation, another form of weakness, especially if you can't even match that low. And now what we can see is a market starting to create lower and lower highs. Okay, downward channel looked like a good spot to cover and lock in some profit. And what I'm also going to use in these bars here is I'm going to use these bars as they close in these extreme wicks as places to gauge my risk. So once these bars close and we have an extreme, my risk moves from that 5 points down to pretty close to break even. Then we have another bar, moves it even down farther into profit. So that's, you know, what we call locks in a free trade, especially once we have or can take out some of these lots. And we follow this thing down. Eventually what happened is we ran out of time. The market closed. So as we can see where we're at here, I covered very, very close to the market close. That's all that I can expect out of this trade. So this worked out very, very nicely. Plus 625, not a bad day's work. Also combined with a few of the other opportunities we got in Dow Jones. And I know a few of the students, as far as they told me, took some trades in Dow where we had a similar situation. We also saw in the beginning, the first thing that I was talking about is how did our open set up? Okay, here's our breakout bar. Unfortunately, I missed this one, but it is the same principles. Came down, opened, tested the low of that drive bar, and up we went. So there was another opportunity which ended up taking you to the upper extreme and then sold off in the close. Okay, so very good stuff. We should expect to see, in varying degrees, every day offers some type of opportunity with, some of the markets we're following, if not many of them. So as I said earlier, in combination today, we had similar occurrences in gold and in Dow. So today was very good. That's it. So this is something we've been working into our practice. A lot of the students are really liking this stuff. If you have any questions, please feel free to look me up at Husky Trading Solutions. Webpage, huskytradingsolutions.com. And of course, those of you who are viewing this on YouTube. Thank you very much.